Before we get to today's picks, I want to clarify something. I have noticed queries about why I've begun discussing stock fundamentals, news, and other non-technical details in these daily videos, despite this channel's focus on quantitative trading. Let me clarify, our algorithm for selecting daily oversold stocks established in 2019 remains unchanged. So why the new layer of commentary? The answer lies in a blend of curiosity and a deeper search for understanding. Over the years, I have always wondered about the stories behind the stocks picked by our algorithm. How do these selections, which we might only hold for 24 hours, fit into the broader market narrative? What can they tell us about market behaviors and trends? I have always seen each of our daily picks as a character. This exploration stems from a desire to delve deeper into the characters behind our daily picks. For years, I have been eager to understand the context around these daily picks, their dynamics at play, and the factors influencing these picks. It's about reverse engineering these picks through a conventional analysis lens. By exploring fundamentals and news, I aim to learn more about my daily picks and, in the process, video journal it. The goal is to satisfy my curiosity, offer a richer view of market dynamics, and who knows, potentially uncover insights and patterns that could inform new strategies when we do a retrospective at some point. And by sharing it with my followers, I aim to foster a community of learning and exploration. I hope this reassures you that our commitment to our quantitative foundation is unwavering. Today's pick number 1 is X. Let's dive into the recent buzz around United States Steel Corporation, which has seen its shares take a significant dive, sparking talks that it might be oversold. This stir comes amidst President Joe Biden's firm opposition to Nippon Steel's planned acquisition of US Steel, a move that's not just about business, but is tinged with national pride and economic sovereignty. Imagine US Steel as the backbone of America's industrial might, a company steeped in history and significance. Now there's talk of it being acquired by a foreign giant, Nippon Steel. Picture the White House stepping in, with President Biden emphasizing the critical importance of keeping strong American steel companies powered by American steel workers. This statement wasn't just a nod to the economic implications, but a clear stance on maintaining the national fabric. The response was immediate. US Steel shares tumbled more than 10%, a market reaction that underscores the weight of presidential words and the intricate dance between national security, economic interests, and the global stage of trade and investments. The deal, under the scrutiny of the Committee on Foreign Investment in the United States, now appears on shaky ground, facing political headwinds that could stall or scuttle the acquisition. This scenario isn't just a business transaction, it's a narrative rich with themes of American identity, job security, and the strategic importance of domestic industries. It's a reminder that in the world of stocks and trades, the currents of national interest and political influence can sway markets, sometimes unpredictably. US Steel's story is not just about a potential deal falling through, but about the assertion of national priorities over global commerce, about the resilience of American industry, and about the balance of power in a world where business and politics intertwine. So, as you think about whether US Steel is now a bargain, remember the layers of complexity that surround this ticker. It's a tale of how global ambitions can clash with national interests, and a reminder that in the stock market, as in life, the undercurrents of history, culture, and politics play a role in shaping outcomes. Today's pick number two is RxSight Inc., ticker symbol RXST. This company, nestled in the heart of Aliso Viejo, California, is pioneering the future of eye care for those who've undergone cataract surgery. With their innovative light adjustable lens system, RxSight is changing the game in post surgery vision improvement. Ranked within the top quarter of its industry by Zacks Investment Research, RxSight stands out in the medical instruments sector, an area brimming with potential. Why is RxSight catching our eye as potentially oversold? Since the year began, we've seen its stock jump by 14.6%, a clear signal of growing investor confidence. This surge comes on the back of surpassing earnings expectations and signaling strong revenue growth ahead. Yet, despite this stellar performance and solid backing from analysts across the board, the stock's price seems to lag behind its true potential. This discrepancy suggests the market might be slow on the uptake, offering a golden opportunity for those looking to invest in a company poised for growth in the thriving eye care market. Today's pick number three is DAVA, also known as Endava PLC. Endava provides a range of information technology services, including software engineering, cloud transformation, test automation, and technology consulting. It caters to sectors like finance, insurance, healthcare, retail, consumer goods, media, technology, and communications. Headquartered in London, United Kingdom, Endava operates within the computers, IT services industry, ranked 74th out of 252 industries by Zacks Investment Research. Despite recent concerns due to a decline in net cash from operating activities, adjusted free cash flow, and changes in client counts and revenue distribution, Endava's strategic acquisitions like Galaxy Group aim to expand its North American healthcare presence, highlighting its growth ambitions. Nonetheless, cautious FY 2024 revenue and EPS guidance may have led to perceptions of the stock being undervalued, suggesting that the market reaction could be an overcorrection in light of Endava's strategic focus on diversification and growth. Today's pick number four is BCE. BCE Inc. is Canada's largest communication service provider and serves as the holding company for Bell Canada. The company provides local and long-distance phone service to approximately 70% of the Canadian population, primarily in Ontario and Quebec. BCE operates within the diversified communication services industry, a sector ranked 93rd out of 252 industries, according to Zacks Investment Research. Imagine you've got a garden. In this garden, you've planted a tree, let's call it the BCE tree. Now, this tree usually grows pretty steady, giving you good fruits every season, kind of like the dividends BCE pays to its shareholders. But lately, a few things have happened that made our tree not look so hot. First off, the weather changed, the financial weather, that is. People found another place to park their money, like guaranteed investment certificates, which are now paying more because interest rates went up. It's like suddenly vegetables are giving more produce than your tree, so people are interested in them now. Then there's talk of a storm coming, maybe a recession, making everyone nervous. People are holding onto their old phones longer, spending less, and businesses aren't advertising as much. All this means less water and sunlight for our BCE tree. And to top it all off, the tree itself had to go through some pruning. BCE had to cut some of its branches, jobs in this case, and make big changes, especially in the part of the company that deals with news and radio. Even though this might be good for the tree in the long run, it looks a bit bare right now, and that worries people. Despite all this, the tree is still expected to grow, maybe even more than last year, and continue giving out fruits. But for now, with everyone a bit jittery about the weather and the pruning, our BCE tree isn't looking as attractive, and that's why the stock is oversold. But just like any seasoned gardener knows, every tree has its seasons, and with care and time, it might just come back stronger. To wrap it all up, BCE's stock is currently in a rough spot for a few reasons. People are looking for safer places to invest their money because interest rates are higher. There's also worry about how a possible recession could reduce spending by customers and businesses, impacting BCE's profits. Plus, the company has been making big changes internally, including job cuts, which can shake investor confidence even if these moves are meant to strengthen the company in the long run. Despite these challenges, BCE is still expected to grow and maintain its dividend payouts, which is a good sign. So while things might look a bit bleak for BCE at the moment, there's potential for improvement as the company adapts and moves forward. Today's pick number 5 is AFRM. Affirm Holdings is an emerging growth company. They are building the next generation platform for digital and mobile first commerce. They believe they can reinvent the payment experience. Their platform is comprised of three core elements: a point of sale payment solution for consumers, merchant commerce solutions, and a consumer focused app. AFRM operates within the business services industry, a sector ranked 170th out of 252 industries, according to Zacks Investment Research. So, why Affirm, a name well known in the buy now, pay later sector, seems to be hitting a rough patch, and why some might say it's oversold? First off, Affirm's stock price has seen better days. It recently dropped significantly, closing down by 13.4% in a single day. However, it did manage a tiny climb of 0.3% after hours. This volatility isn't new. The stock has swung between highs and lows over the past year, which could make any investor's head spin. Now, let's talk numbers. Despite pulling in sales of around $191 billion and boasting a market cap of about $1026 billion, Affirm is struggling to keep its head above water in terms of profitability. The company's net margin is in the negative territory at 39.19%, showing it spends more than it earns. Its return on equity, another crucial indicator, is also in the negatives, highlighting inefficiency in using shareholders' funds. Debt is another piece of the puzzle. A firm's debt to equity ratio stands at 235, indicating it has a considerable amount of debt when compared to its equity. This could be a red flag for some investors, signaling potential financial stress. Wall Street analysts have mixed feelings about a firm. While some are optimistic, the majority suggest a cautious approach, with ratings ranging from sell to hold and a few buys. The average price target among these analysts suggests the stock might see a further decline, adding to the sentiment that it might currently be overpriced. Macro factors also come into play. With the Federal Reserve maintaining high interest rates, consumer borrowing and spending could tighten, directly impacting companies like a firm that thrive on consumer credit. Despite these challenges, there's a glimpse into the company's strategic moves with an upcoming CFO fireside chat. This event could shed light on a firm's path forward and might just sway opinions. In conclusion, while a firm holdings faces notable challenges, including fluctuating stock prices, concerns over profitability, and a high debt to equity ratio amidst a challenging economic climate, the perception of it being oversold might offer a unique opportunity for discerning investors. The upcoming CFO fireside chat represents a potential turning point. This event is keenly anticipated as it could provide valuable insights into a firm's strategy to navigate its current hurdles and leverage its position in the digital and mobile first commerce arena.